It's not so much about growth projections as much about the trade-off and whether it was working in their favor. And a very simple metric of whether you're creating value by investing is to look at what you earn as return on your invested capital versus what it costs you to raise capital, the cost of capital. So if you have a return on capital that exceeds your cost of capital, you're creating value. If it's equal, you're kind of running in place. And if it's less, you're destroying value. 2/3 of the 42,000 companies that I looked at are earning returns on capital less than the cost of capital. Some might have very good reasons. It might have been a bad year, but that's not a good sign. That tells you that a lot of growth around the world is more value destruction than value creation. The 4 questions you always have to ask when you look at a company is, what are your cash flows from your existing investments? You've already been on the ground for a while. What are you doing with all those assets? The second is, what's the value of growth? The third is, how risky are you as a company? And the final question is, when will you become a mature business? Because I need to tie up some loose ends. Unless I answer those 4 questions, I really cannot value a company.